Hi everyone, my name is Busari Abiodun. Welcome to my channel. In this video, I'm going to discuss about single entry and incomplete record. Under this video, we'll be looking at the meaning of single entry and incomplete record, the distinction between single entry and incomplete record, and we will be taking an exercise under incomplete record. Single entry and incomplete record. This mostly occur when financial records are handled by someone with little or no background knowledge of accounting. In this case, the financial record that will be made available may not be enough to prepare the final account, which is trading profit and loss account of an entity, in order to ascertain the profit. So, what is single entry? Single entry occurs when available accounting records are prepared on a single entry basis, making it difficult to drop off the trial balance from which the final account will be drawn. Like we all know that account is prepared based on double entry. We state that for a corresponding debit entry, there must be a corresponding credit entry, and for every credit entry, there must be a corresponding debit entry. A situation whereby an account is prepared on a single entry basis, we call that single entry. So, such an account may not be possible to drop a trial balance in order to prepare trading profit and loss account. But when we are talking about incomplete record, this occurs when the available information is not enough to draw up the record of sales and purchases, making it difficult to prepare the trading profit and loss account. Now, how do we determine the profit? So there are two approaches to determine the profit under single entry and incomplete record. The first approach is statement of financial position approach, while the second approach is matching concept approach. So, statement of financial position approach. This is used when in the case of incomplete record, that is, statement of affairs at the beginning of the accounting period will be prepared, statement of affairs at the end of the accounting period will be prepared, and the difference between the two will determine the profit. The statement of affairs is used to determine the capital of the business. So at the beginning of the year, when it is prepared, it is used to determine the opening capital. The statement of affairs at the end of the year is used to determine the closing capital. So if there is difference, that is, if there is increase in the capital of the firm, that means it indicates profit, and if there is decrease, that indicates loss. Now let's take an illustration. Fadwa does not keep proper book of account for the year ended 31st December 2020. The following information are available for the year. So we have the record of the asset as at the 1st of January. We have the record of the asset as at the 31st December of year 2020. That is stock, debtors, overdraft, prepaid expenses, cash, motor van, furniture and fitting, creditors, and accrued expenses. Those are the record of assets and liabilities of Fadwa which are provided. So let's look at the additional information. We are to prepare a statement to show the profit or loss made by Fadwa for the year ended 31st December 2020, taking account of the following information. That is, the first adjustment, 400 naira of the debtors at 31st December 2000 were turned bad debt, and also a provision of 500 naira is to be made for doubtful debt. The second adjustment, during the year, the owner withdraw 1,000 naira each month from the business. The third adjustment, during the year, Fadwa received donation of the sum of 4,000 naira and paid it into the business account. While the last adjustment is that the following assets are to be depreciated: motor van 10%, furniture and fitting 5%. You can take down the questions before we begin the solution. So now we want to start the adjustment working and the solution to the problem. So like we have the summary of the questions, the illustration, we have the record of the assets and liabilities, and we have the adjustment at the other side under the additional information. Now let's start. So from the information, we will realize, let's look at the adjustment. 400 naira of the debtors are 31st December 2020 were termed bad debt, which means debtors, it needs to be adjusted under the additional information. That is, we are going to adjust debtors. The second information, during the year, the owner will draw 1,000 naira each month. So that's a drawing. So that has nothing to do with the information we have in the balance sheet here. So the third adjustment, during the year, Fadward received donation to the sum of 4,000 naira and paid it into the business. That is an additional capital, so that does not require adjustment under the information under the balance sheet. While the fourth one, they say the following assets are to be depreciated. The motor van, 10%. That means motor van, we are going to adjust motor van. So the same thing happens. We have furniture and fitting, which means we are also going to adjust furniture and fitting. So which means from our record of the assets and liability, we are going to adjust debtors, we are going to adjust motor van, and we are going to adjust furniture and fitting. Now let's begin. So we are required to prepare the statement of profit or loss made by Fadward for the year ended 31st December, taking into account of the following. Now we want to find the record of the profit, whether the business make profit or loss. How do we calculate profit in the case of incomplete record? Just like I said, that means we are going to find. So that means we are going to find the capital of the business at the beginning of the year. We find the capital of the business at the end of the year, and we can only do that by preparing statement of affairs. So which means under this method, we are going to use statement of financial position approach. Like we said, statement of affairs is like a summary of statement for financial position, because we prepare it by adding all the assets together and deducting all the liability from the assets. So the balance we gives the capital for the business. So that means we are going to use the entry as at the 1st of January to prepare the statement of affairs for the beginning of the year. We are going to use the entry as at 31st of December to prepare the statement of affairs at the end of the year. So a situation whereby the closing capital is bigger than the opening capital, that means the business make profit. But if the closing capital is less than the opening capital, that means the business run into loss. Now let's start the solution. We have Fadward. So statement of affairs for the year ended 2020. So now what are the information? So we have the 1st January and we have 31st December. So we want to prepare the statement of affairs on a single sheet. So the next thing is that the denomination, if it is naira or dollar, we put the denomination there. Now let's start the question. So the first entry, we have stock. As at 1st January, 14,000 naira, 31st December, 12,000 naira. So there is no adjustment. So stock or inventory. So stock also means inventory. So should, in case in the question you are having inventory, you should know that we are still talking about the same thing. So stock as at 1st of January, 14,000 naira. So stock as at 31st of December, as you have it there, 17,000 naira. Then you input 17,000 naira. So we are done with the stock. So the next entry, now debtors. If you look at it, under debtors there is an adjustment. So what does the question says? 400 naira of the debtors are 400 naira of the debtors at 31st December 2020 were termed bad debt. What is bad debt? So if you are talking about bad debt, we are talking about all those debts that the business think will not be able to recover again. So they decided to write it off. So debtors, just like I said at the beginning of the year, so is 4,000 naira. So the adjustment will be based on the end of the year, is on the closing balance. So at the end of the year, our debtors 3,500 naira. So that means we are going to have debtors. So like I said, bad debt is termed. A debt is termed as bad debt when the business realizes that such a debt will not be able to be recovered again. For example, the death of a debtor or the disappearance of a debtor is an indication that such a debt cannot be recovered. So the business writes such debt off from the book. So that kind of debt is termed as bad debt. So just like I said, so the bad debt is 3,500 naira. So the first working, which is debtors, we have balance brought forward, which is how much? 3,500 naira. So now from the amount of the debtors, 3,500 naira, so we were told that 400 naira is to be written off as bad debt. So bad debt written off 400 naira. If we subtract 400 naira from 3,500 naira, we are going to have 3,100 naira. So let's read further. So, and also provision of 500 naira is to be made for doubtful debt. If you are talking about doubtful debt, that is the business, they are trying to take precaution. That is because there are some likely debt. Maybe they realize that they have been noticing some debtors that they may not be able to pay their debts. So the business try to play safe by setting aside some amount to take care of that. So it is called doubtful debt. The amount can increase or decrease as year goes on. So the same thing, it also has the same treatment. We are going to remove it from the amount of debtors. So doubtful debt, 500 naira. If we deduct 500 naira from 3,100 naira, we are going to have 2,600 naira, which means at the end of the year, the value of our debtors is going to be 2,600 naira. So we put it 2,600 naira. Now the next entry. So we have overdraft. Overdraft is a liability. This occurs when a business withdraw more than they are having in their bank account. It is called overdraft. It is a liability. Then the next item, we have prepaid expenses. What is prepayment? Prepayment means payment in advance. That is when you make payment in advance, so the extra amount you made is called prepayment. So prepayment can be income, it can also be expenses. So prepaid income is a liability. This occurs when a business receives money more than what they supposed to receive. For example, for a business that have an office and rented out part of the building, maybe they receive rentage in advance. Maybe one of the occupant of the building make payment of 2 years. At the end of the first year, it means the business will still be owing the occupant the amount for the other year. So such amount, the money received is an income. So such amount will be termed as a liability. So that's what we call prepaid income. But in a situation where a business made payment in advance, maybe for example, they pay rentage for 2 years. At the end of the current year, the other year will be regarded as prepaid expenses. So that is an asset. So we have prepaid income, we have prepaid expenses. Prepaid income is a liability, prepaid expenses is an asset. Just like you have repayment, you also have accrual. Those are the two commonly used in account. We are talking about accrual. Accrual means debt. So in case of the accrual, when we are having accrual income, it means the money you're supposed to receive that are still outside, which means customers are still owing you. Such an income is an asset. But if you are talking about accrual expenses, it means something that the business have benefited which they've not paid for. For example, at the end of the year, the business made payment of 8 months out of 12 months that is in a year. The remaining 4 months that is left to be balanced is called accrual expenses. So such an expenses is a liability to the business. Now let's continue. We said prepaid expenses, that is expenses paid in advance. So that is also an asset. At the beginning of the year, prepaid expenses, it is how much? 300 naira. So at the end of the year, if you look at it, the prepaid expenses is 400 naira. So that take care of the prepaid expenses. Then the next item, we have cash. At the beginning of the year, there's no cash. So which means at the beginning of the year, we don't have cash. But at the end of the year, what is the amount of cash? 2,200. Cash is also an asset. So now the next one is motor van. Motor van is an asset, but we are to adjust the motor van. What does the information talks about? Under the additional information 4, the following assets are to be depreciated: motor van 10%, furniture and fitting 5%, which means we are to depreciate motor van by 10%. What is depreciation? That is a reduction in the value of an asset as a result of passage of time. So which means motor van at the beginning of the year is how much? 6,000 naira. So we have motor van 6,000 naira for the beginning of the year. As at the end of the year, just like I said, we are going to adjust that. The amount is 5,000 naira. So that means we are going to work it out. Working number 2, motor van. Balance brought forward. How much is the amount? It is 5,000 naira. So we have balance brought forward 5,000 naira for motor van. So we are to depreciate it by how much? 10%. So which means less depreciation, 10%. 10% of 5,000 naira is 500 naira. If we deduct 500 naira from 5,000 naira, it's going to give us 4,500 naira, which means our motor van at the end of the year, the value is going to be 4,500 naira. Then the next item, which is furniture and fitting, we are also to depreciate furniture and fitting by 5%. So working number 3. So our furniture and fitting at the beginning of the year is 4,000 naira. Just like I said, it's at the end of the year we are going to adjust. So working number 3, the furniture and fitting is 3,000 naira. So the balance brought forward for furniture and fitting will be 3,000. The balance brought forward for furniture and fitting will be 4,000 naira. So now let's for 5% depreciation. So less depreciation, 5%. 5% of 4,000 naira is going to give us 200 naira. If we subtract 200 from 4,000 naira, the balance will be 3,800 naira, which means the furniture and fitting at the end of the year is going to be 3,800 naira. We put the amount 3,800 naira. Then the next entry, we have creditors. Creditors is a liability. We have accrued expenses. Just like I explained earlier, accrued expenses is also a liability. That means we are done with the record of the assets. So now let's add everything together. The value of our asset as at 1st of January, if we have 14,000 naira plus 4,000 naira plus 300 plus 6,000 plus 4,000 naira, is going to give us 28,300. Then what is the value of the asset as at the end of the year, that is 31st of December? 17,000 plus 2,600 plus 400 plus 2,200 plus 4,500 plus 3,800 is going to give us 30,500. That means that is the total amount of the asset of the business at the beginning of the year and at the end of the year. Now to know our capital, that means we are going to subtract the liability from it. Now let's start. So we have overdraft at the beginning of the year, 2,100 naira. There's no, so let's overdraft. So how much is overdraft? 2,100. We are going to subtract 2,100 from it. So at the end of the year, overdraft, there's no value for overdraft at the end of the year, which means we don't have value for it. Then the next liability, let's look at it. We have creditors. So creditors is 1,000 naira at the beginning of the year. So creditors at the beginning of the year, 1,000 naira. So at the end of the year, the value of the creditors is how much? 1,200 naira. So which means at the beginning of the year we have 1,000 naira. At the end of the year we have 1,200 naira. Then the next liability you are having is accrued expenses. Accrued expenses is at the beginning of the year is 1,700 naira. So under accrued expenses 1,700 is also a liability. We are going to subtract all those ones. That has the reason why they are being put in bracket. In account, if you want to subtract, we use bracket to indicate subtraction. So at the end of the year, accrued expenses is 1,400. So we are going to subtract 1,400 as at 31st December. So if we look at it, we are done with all the entry. Now let's subtract 2,100, 1,000 naira, 1,700. If you subtract them from 28,300, it's going to give us 23,500. So as at 31st December, we have 30,500 as the value of the assets. If we deduct 1,200 and 1,400 from it, it's going to give us 27,900. So which means at the end of the period, the value of the capital is 23,500 for the beginning of the year, 27,900 for the end of the year. So now we say we want to calculate the profit for the year, and just like I said, what is the formula for profit? The closing capital, we already have the value of the closing capital, but the closing capital of a business equals to the addition of open capital plus additional capital plus profit less drawing. It's very simple. If you remember under our balance sheet, if we want to prepare the balance sheet, we said capital, add additional capital, add profit less drawing. So which means that will give us the value of the closing capital, and what you are looking for is profit. Applying the simple arithmetic by collecting the like terms, profit is going to be equals to closing capital minus open capital minus additional capital plus drawing. From our calculation, if you remember, we've already find the value of the open capital, we've already find the value of closing capital, and we've already find the value of open capital and the closing capital. So now closing capital is 29,700, just like we have it, and we said under the formula we said less open capital, that is less open capital. What's the value of the open capital from the account we just prepared? Our open capital is 23,500, so that will be minus 23,500. Just like I said, we use bracket to indicate minus. So 27,900 minus 23,500, that is going to give us 4,400. So from the formula that, like we still have it above, less additional capital. Do we have additional capital? Yes. So if you look at the information during the year, the third additional information during the year, Fadwa received donation to the sum of 4,000 and paid it into the business. That 4,000 is an additional capital, so that means we are going to deduct it less additional capital, which is how much? 4,000 naira. So 4,400, if we subtract 4,000 naira from it, we are going to have balance of 400 naira. So now we said minus additional capital plus drawing. Do we have drawing? Yes. So what is our drawing? Let's look at additional information too. They said during the year, the owner withdraw 1,000 naira each month from the business. If the owner withdraw 1,000 each month from the business, let's calculate it. Working number 4, drawings. So 1,000 each month. How many months do you have in a year? We have 12 months. That will be 1,000 times 12. That is going to give us 12,000 naira. And under the formula we say add drawing. So that means 400 naira plus drawing, 12,000 naira. If we add everything together, it's going to give us 12,400 naira, which means the value of the profit for the year is 12,400 naira. So now let's now prepare the statement of financial position. So the statement of financial position for the year will be based on the closing balance. So statement of financial position. So we have assets. You just like we know, we have non-current assets, which is otherwise known as fixed assets, and we have current assets. So we are starting with non-current assets. So what are the non-current assets? Let's look at it. So those are the record of our assets. We have stock, we have debtors, prepaid expenses, cash, motor van, and furniture. The non-current assets, we are talking about non-current assets, we are talking about assets that their lifespan is over a year. So as we have it here, the non-current assets we are having here are motor van and furniture and fitting. So which means motor van, how much? 4,500 naira. Then the next one, furniture and fitting. How much is furniture and fitting? 3,800 naira. Remember that we are dealing with the closing balance. So those are the two non-current assets we have. If we add them together, it's going to give us 8,300 naira. Now, current assets. So what are the current assets we are having? So the current assets we are having here are stock, debtors, prepaid expenses, and cash. Now stock. So the value of stock is 17,000 naira. So debtors, our debtors here is 2,600 naira. So we put 2,600 naira. Then the next one is cash. What is the value of our cash? We So the next one we're having is prepaid expenses. Is cash, which is 2,200. So the value of our cash is 2,200. Then the next one we have prepaid expenses, which is 400 naira. Those are the non-current assets we are having. So if we add everything together, so there's no non-current assets again. So if we add everything together, it's going to give us 22,200. So 8,300 for non-current assets, 22,200 for current assets. If we add the two of them together, it's going to give us 30,500 naira. That is the total of the assets of the business. So now less liability. We are going to deduct liability from it. So what are the liabilities we are having? So what are the liabilities we are having? So the first liability we have overdraft. But at the end of the year, we don't have overdraft, so that means we are going to skip that. Creditors. What is the value of the creditors? 1,200 naira. Then the next one liability you are having is what? Accrued expenses. What is the value of accrued expenses? That's 1,400 naira. So if we had 1,200 and 1,400 together, it's going to give us 2,600. That is the total of the liability. So now if we deduct 2,600 from 30,500, we are going to have 27,900. So the 27,900, that should be equivalent to our closing capital, and that is the net assets for their business. So that is all about the incomplete record. If you have any question, you can drop it under the comment section, and don't forget to like the video, subscribe to the channel. The subscription is free, and share the video with others. So thank you very much.